What's up, everybody? My name is Joe Brown, and this is Heresy Financial. And today, we're going to get nerdy. We are talking about the difference in fairness, or which one is more ethical, between government borrowing to fund its expenses versus the government using taxes to pay for its expenses. The reason why we are going to be looking at this is primarily because we are inching closer and closer to a fiscal cliff where the government is spending more and more and more, and slowly but surely inching its way towards issuing massive more amounts of debt. And this chart behind me, as you can see, this is the federal surplus or deficit. And I'll throw it up on the screen here so you can see it. That purple line is the zero mark. So when in a given time frame, this one is quarterly, the federal budget comes in as a surplus, meaning they get more in income from taxes than they spend, then it's going to be above that purple line. And you can see it's been a long time since we've been above that purple line. And recently, you can see we are drastically lower. We haven't had deficits like this as a percentage of GDP since World War II. And so we are talking about this today because there is a fundamental difference between the government funding itself through borrowing versus through taxes. And don't you worry, I will not forget about the Federal Reserve, because that severely changes how these dynamics work as well. Ready? Let's dive in. All right, so that we can all be on the same page, we are going to start off looking at the comparison between borrowing and taxes without the existence of the Federal Reserve. We're just going to start off in a hypothetical world, fixed money supply, where the only source of borrowing or taxing is just people and companies in the country. So we have to start there before we can understand the role that the Federal Reserve plays. So first, let's look at taxes. Taxes are involuntary, right? Because elected officials, Congress, they will decide how much and who gets taxed. It's important to remember the federal government does not produce. They do not create value. They are only a wealth transfer vehicle. They only transfer wealth from point A to point B, wherever those 2 points are. They're not creating anything and then not spending it. They're only spending what they've taken from somewhere else. So taxes, number one, they're involuntary, even though it's decided by elected officials, which has the element of voluntarism in there, but it's involuntary because somebody decides, hey, you and you and you are going to give us some of your money, and it's enforced via a monopoly on violence, and then that money is then transferred to other people or other corporations, and ultimately that always lands in somebody's bank account, right? So the government is going to spend money on to a company for a military contract, like it's going to go into the bank account of Lockheed Martin, or it's going to go into the bank accounts of politicians, or it's going to go into the bank account of somebody on unemployment insurance, or it's going to go into the bank account of a state or a city treasury. So ultimately, taxes are a wealth transfer mechanism from some people, certain people, to others. It is involuntary and it is explicit because everybody knows exactly, or if maybe they don't know, but they could find out if they want to know exactly how much they pay in taxes. You just have to look at your pay stub or you look at your tax return at the end of the year. All right, so that is taxes, pretty straightforward. Now let's look at borrowing, and especially with deficits like this. Crazy historically high deficits, and especially with the national debt growing the way it's been growing for the last couple of years, last couple of decades. I think you can make a pretty strong case borrowing is a more fair way for the government to get their hands on revenue, a more ethical way. Again, in this hypothetical example, we're removing the existence of the Fed. So how does the federal government borrow? It is not coerced. It is not involuntary. They pay an interest rate and they borrow from whoever wants to lend. So the government doesn't choose who they borrow from. It's the lenders choose if they want to lend to the government or not. Usually that's wealthy individuals. Usually that's corporations, institutions with large cash piles. They want to make a little bit of an interest rate, so they lend that money to the government. And remember, all government spending is wealth transfer. So they're taking money from one area, putting it into another. And so government borrowing is a mechanism by which the government can redistribute wealth even if it's temporarily, they can transfer wealth from the corporations and the wealthy to whoever they decide they're going to transfer that wealth to. And again, usually that's other corporations or politicians. Sometimes it's, welfare, healthcare, things like that. But we run into a problem here because let's say hypothetically you could press a button and say that the only way the federal government could get any money is by borrowing it. They weren't allowed to tax anymore. Well, suddenly you run into an issue where the debt from then on can only grow, because if you don't have any other source of income other than the debt, well then to pay back that debt, you need to get new debt. And you're paying an interest rate because by definition it's debt. And so that debt amount only grows. It cannot ever go down. So the reason why you have taxes, theoretically in this hypothetical example, is to eventually pay off that debt and not have to keep on rolling it over. Which means it's kind of twisted that the people who are lending to the government, the wealthy, corporations, are being repaid, getting their profits, even if it's nominal, even if it's not positive adjusted for inflation, they're getting their profits on those loans as a result of the middle class having to pay taxes and bear the brunt of the tax burden. Okay, so now we understand the only two ways that the government can get revenue, can get income, is from taxes and borrowing. We understand that that comes from individuals. Taxes is involuntary from some people. Borrowing is voluntary from some people. And then they spend that wherever they want. Those are both wealth transfers, and neither of those is inflationary. Neither of those is something that will expand the money supply because they're taking money from one group of individuals and giving it to a different group of individuals. Neither of those is inflationary. But now, let's enter into the real world where we have the existence of a central bank in the US, the Federal Reserve. Now, many people like to point this out all the time, but the Federal Reserve does not print money. They print bank reserves, which is just a fancy way of saying the banks loan money to the government, and then by loaning that money, now there's a treasury created. So there's a contract that states federal government owes money, owes dollars to the bank. The bank suddenly decides, I don't want the government to loan me this money anymore. And they say, does anybody else out there in the market want the government to owe you money? You can buy this contract for me for the full price. And then sometimes other participants in the market will buy or sell those. There's an exchange. There's the treasury market is the deepest, most liquid market on earth. But there is a buyer in that market who can create money in order to buy those treasuries, buy those contracts. So many times banks will get these contracts, they'll create a treasury, they'll create that loan, they'll loan money to the government, and then they'll turn around and they'll sell that debt to the Federal Reserve, who creates money out of thin air in order to give that money to the bank. The bank can turn around then and repeat the process. So the bank is acting as a middleman. But from the start to the finish, what's happening is the Federal Reserve is printing money to loan to the government. And when that debt gets repaid, it goes to the Federal Reserve. Now, ultimately, the Federal Reserve isn't keeping its own profits. After its expenses, profits from the Federal Reserve are swept back into the Treasury. So any national debt that is owned by the Federal Reserve is basically interest-free debt. The federal government does not have to, in the end, have a net interest payment on that debt because those profits are swept back into the Treasury. But we've gotten off on a little bit of a rabbit trail here. So why does it change things if you have a money printer stepping in to lend money to the government? Well, we have to ask the question, where does purchasing power come from? In our previous example where you had a closed fixed system, it's very simple to understand where purchasing power comes from because it's just the units of currency in existence. You're not dealing with the complication that arises from an expanding or contracting supply of money. But when you have an entity who prints money, then loans that newly printed money to the government, and the government then spends that money into existence, you do have a growing pool of money. And so the mechanism here is that the new money that's printed only has purchasing power as a percentage of all the existing money already in the system. Let me say that again. If you print a bunch of new money, that new money only has purchasing power as a percent of all the existing money. And I really like the example of a Monopoly game in order to show how this plays out in real time. Let's say you're playing Monopoly and you double the supply of money. You just go around everybody, double their money. What will happen at first? Everybody feels rich because they can afford everything at the current prices. And so you'll have people start buying more houses, buying more hotels. When properties go up for auction, they'll go at a much higher price than they would have before because people have more money to spend. But then as you go around that board with costs that have just gone up, your cash starts draining really quickly, players start getting knocked off. It's always been a winner-take-all game, but you have some with a much higher concentration of wealth. That wealth concentration gets a lot steeper. That wealth inequality gets a lot steeper in that game if you double the supply of money versus if you hadn't done that to begin with. And so in an economy, if you increase the supply of money, first of all, you're not just distributing that equally and doubling. If somebody has $100 to their name in their bank account, they get $200. If somebody has 10 million, they get 20 million. You're not just doing a direct doubling of the supply of money like would happen with, like a stock split where they just double the number of shares. Remember, government spending is a wealth transfer game. And so the government is spending that money, choosing where it goes. So if they spend $10, maybe one of it goes to individuals or three of it goes to individuals' bank accounts. 3 of it goes to politicians, governments around the country. The other 3 of it goes to different corporations and organizations. It's a wealth transfer game. But here's the key. Those new dollars that were printed and brought into existence so that they could spend them places, their purchasing power comes from all the other dollars that are already in existence. So you've got a person over here who's got $10,000 to their name. It's in cash, it's in their bank account, and then the government passes a stimulus bill. And that stimulus bill sends him a $1,000 check. So he gets $1,000. But that's not all of the money that was created, and that's not all the money that the government is spending. There was a lot more money created, and that money is being spent in various ways across the country. Remember, wealth transfer, redistribution. So while his total dollars went up from 10,000 to 11,000. Those new dollars are entering the economy all over the place. Well, just like the game of Monopoly, those are going to start bidding up the prices because those new dollars had purchasing power and they're transferring it from the existing dollars. So now that $11,000 goes to be spent, that person goes to spend his $11,000 and realizes something that used to cost $10,000 now costs $15,000, now costs $20,000. And we can see this has happened. That's the theory, but all you have to do is look back at the last 2 years and see that's exactly what's happened. Look at all asset prices. Look at real estate. Look at the stock market. Look at cryptocurrency. Look at used cars. Look at new cars. If you haven't been in the market for a new car lately, go look at the markups that dealers are charging all over the country. It's basically not possible to get MSRP anymore. If a dealership has a certain vehicle in stock that people want, they're going to have a massive dealer markup on it. We obviously know that food and energy prices have been skyrocketing as well. And so that person who had $10,000 to their name had, let's say, $5,000 of their purchasing power transferred to others. So even though nominally they went from 10 to 11, in real terms, it was as if they went from 10 to 5. And so that is why funding via the Federal Reserve printing money, even though it looks like borrowing, it is not. It is inflationary. It is an expansion of the money supply, and it is invisible. It is very hard to calculate how those prices are affected as a result of debasement versus just a result of prices moving on their own. So it's very difficult to make correct economic calculations when you have the money supply being changed so rapidly. You're transferring wealth from any savers, from wage earners, into the hands of others because all government spending is a wealth transfer. And to the extent that they're spending money that is deficit spending funded by central bank printing, they're transferring all of that purchasing away from savers into the hands of others, mainly asset holders. So that's it. Hopefully I didn't make things too complicated. Hopefully that cleared some things up about the differences between government spending that is funded by either straight borrowing, straight taxes, or printing. And finally, if you'd like to buy gold, silver, Bitcoin, or other cryptocurrencies in an IRA to protect yourself against capital gains taxes, go sign up for I Trust Capital. And if you use my affiliate link in the description below, you'll get $100 worth of Bitcoin just for signing up. As always, really appreciate you guys. Thanks so much for watching. Have a great day.